concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
We're going to get the spoken word on the stock market now with our chief equity strategist, John Blank. He's sitting right here next to me. Imagine that. Not very often we can say that.
True.
So we're up against another earnings season for the first quarter this time. It's already begun. What do you think? Is this going to be the main stock market driver here in the U.S. for the next couple months?
I don't think so, Terry. I think it's bad enough that the bar is low enough, and it's in the past. So I think what we got to focus on out of this earnings season is guidance.
Okay.
Forward guidance, Terry, is going to matter a lot to this market. However, even that in the face of the oil prices is probably coming in second place. Because what we have here in terms of this earnings recession is all price-driven collapses, not volume-driven collapses. What I mean by that is oil and materials collapses, prices have dropped the EPS down. Mm-hmm. So as they rise, the implications built in that those EPS numbers are going to rise. So that's the feedback, and it's a clean feedback. And that's why you can say with forward guidance and a forward look on these oil prices.
All right, we're sitting here talking on April the 13th. Talk to me about China. Before we came into the studio here earlier this morning, the data shows that their exports were up. Are they turning a corner?
I think they are. I think the PMIs a week ago said even further on that. The services are certainly strong and expansion is on for a great bulk of their economy now. And they have posted above 50 on manufacturing after multiple months.
Yeah.
That's a bigger deal than you realize because it turns the whole region around. It turns commodities around, and it delinks China from this oil price story.
Okay.
So that's all good news, and we got to wait for May the 3rd to see the next PMI manufacturing number out of China. If that thing goes above 50 again and we're on a trend, bull market in China.
So sticking here in the U.S., what impact is the election cycle this year going to have on the stock market, especially the general election outcome?
Right. The presidential election, Terry, as you and I have talked about, is an insurgency campaign from the left and Bernie Sanders and from what might be called the right with Donald Trump. But the bottom line is they're the new faces, or they're challenging the establishment, and they're getting their strength from outside the system. Mm-hmm. New voters or anti-establishment types. So the problem we have here is this is a very volatile situation. You don't know the poll outcomes because you don't know who's going to show up for the polls. And this is a problem with thinking about this election like we've thought about over the last 30 years, where you had two candidates from the establishment and they went head to head. We may have a dogfight at the RNC convention. Mm-hmm. We don't know how that's going to turn out.
But so far the market seems pretty sanguine about that.
It's true. But as time goes on, that sanguinity will start to peter into reality. There's something, if in fact we get into a scenario that looks a little tough, we can see some volatility morph itself. So this is what we got to worry about. Is the scenarios are fairly broad here, from fairly benign, and we didn't realize how benign it will be, to some type of volatility that does spook the markets.
Might that volatility occur if, let's say, an independent candidate gets thrown into the fray?
Yes, in fact, or I think, honestly, if Trump gets the nomination and it gets to looking like he's going to win, we're going to see how this market reacts to that. I think that's going to be the big wild card.
So as far as you're concerned, at this point, the market hasn't priced in anything along those lines?
No. What I've learned from poll numbers and reading is that from 6 months into the election, the poll numbers start to correlate with the final outcomes, meaning people are starting to take this choice seriously. So that's why we're seeing a lot of different primary results and a lot of different tone in the media, because from now on out, when you get a poll out in July and August, you're getting 3 months out, 2 months out, and this is going to mean this is what you're going to get, and the market's going to always look forward and say, well, that's the outcome. What do I want to do about it? So that's why this market starts trading in the presidential election by summer.
Okay. So outside of the U.S., you say the non-U.S. bull is alive and well. Why?
First of all, those PMI numbers I've talked about, certainly the case. The other one is Japan. Japan has been a weird thing. If you think anything has been weird in the United States, go take a look at Japan. They put negative rates on. There's a problem with the economy and growth, and the yen rallies from 125 to 190. Strengthens. I mean, people are putting money into Japan when it's falling off a cliff, and the negative rates are trying to scare you out of that. So Nobody really understands that. I read a lot of news stuff on that or research on that. Nobody really understands. I think it's going to reverse. That means I think the bull will come back and play into Japan. So we have that as the second thing. Then we've got this basic idea that oil prices are on their way to $50. We got the April 17th meeting with OPEC and non-OPEC. We've seen a realignment of Russia and Saudi Arabia. A lot of why the Russians got out of Syria a couple weeks ago is because they have to make a deal with the Saudis now. And the last thing you want to do is be fighting over Syria while you're making that deal. And that's what's going on. So now we've got a kind of a new alignment of authority in oil. And, 50 may be a lowball number. That may be where they want the floor at the back end of this thing.
Okay, yeah, I've heard some talk about 70 in the past few days.
Yeah.
What about rates?
Rates, a box has been put over the rate system, meaning the Fed has raised and will raise short-term interest rates. And the theory when I was in school was that raised long-term interest rates. That hasn't happened.
Yeah.
We've gone from 2.5 to 2.2 to now 1.7 on the 10-year. Why? Because negative rates are pushing people out of central banks in Japan and Europe, and they're putting the money in the 10-year Treasury. So what's happening is we're getting a very flat term structure as the Fed raises rates, and the compression happens on the safe haven play on the long end. So it effectively disintermediates any actions by the Fed. So now we've basically got more stimulus than we may or may not want out of the rest of the world from monetary policy, which puts a floor under stocks and lights them up anyways, which is why we've seen the consumer staples and the utilities and the telcos all rally. But what the problem is you blow the rates out, you limit the amount of income the bank system can get. And the bank system has been the Achilles heel from the get-go on this thing. And that is playing out in the big banks this week, and going forward, it can't get better until this whole topsy-turvy long-short thing works itself out, and that, frankly, is not going to work itself out for at least another year.
All right, that brings us all down to sector talk. So you say, at the moment, it's all about the consumer staples.
Consumer staples is this low-rate story. Because why? Because you can buy a 2.5% dividend stock in this marketplace. You can buy it at a decent valuation, even though they're grossly overvalued from what they should be. But given the low rates, you can also find 6-7% growth, which to an institutional manager looking to money to work who used to buy bonds, he's going to go there first. He's not going to go into a small cap or an international stock with a lot of currency exposure and weird political risk. So this spot up the ladder of risk is where people go.
So give me some names.
Names I like: Unilever, ticker UL, which is a European, like a Nestle or Colgate-Palmolive, a big company. So they're priced in European stocks, so the valuation's good, but the growth is there. And they've got a nice, stable consumer staples product line, very diversified. Other names that I like Johnson & Johnson, ticker JNJ, which is a U.S. company. They are across 3 sectors of healthcare: the products, the services, and the drugs. And this is a very, very, very defensive name. Pays a dividend, attractive for those institutional investors who are looking for up the ladder of risk. The third one, a little more risky name, Terry, but I like this name because if you think the PMIs in China are going to turn, this name is going to come and up, and that's Lenovo Group, ticker LNVGY. Lenovo Group is the big PC maker in China, mainland China, and this stock is $15. It used to be $36. It's about done being shorted down on this whole China's falling apart story and the PC world falling apart story. All that stuff has been true, so that it's priced in. So now when you got a forward look, sooner or later, and I don't know where the bottom is, I don't think anybody can tell you where the bottom is, but for someone with a year or two horizon here, Lenovo looks very attractive and frankly more attractive than the other 2 names from a price appreciation point.
So actually, your sights are set on more than just consumer staples. There's also healthcare and infotech in the mix.
Right. Yeah, exactly. Behind the story of my sectors, I'm just going to lay out Unilever as an example of consumer staples. But healthcare, you're just looking for a defensive name in healthcare, not a biotech name, right? You're looking for something that pays dividends, has big cash flows. Look at the price momentum. Notice that it doesn't move much, meaning it doesn't get shorted or sold out in these blowouts. That's the kind of stock you're looking for because that's appealing to this hardcore guy that used to buy bonds. He can't buy bonds. What do I do?
All right. There you have it, the spoken word. Hot off the presses from our chief equity strategist, John Blank. With John, I'm Terry Ruffalo.